Are you excited to hear about our economy from the esteemed Jerome Powell? I'm sure he'll say everything's okay. Ladies and gentlemen, I'd like you to salute. I'd like you to give an 07. By this time next year, we will no longer be seeing Jerome Powell. No home Jerome is coming to the end of his tenure. He has I think there'll be one in January and one in March, and then he's gone by May. He's been involved in the Federal Reserve since 2012, appointed twice by Trump, starting I think in 2018 and then again in 22. We're coming to a pretty monumental situation today. Now, again, I always remind everybody you have to do a quick primer because anyone's new. The main decision they make is around interest rates, aka the cost to borrow. Short-term interest rates. If you think the biggest problem in the economy is jobs, not enough jobs, the economy's slowing down, you lower interest rates. If you think the biggest problem is inflation, you raise rates. You make it more expensive to borrow to slow things down a bit to bring prices down. Okay? So these are the two choices. You lower or you raise based on what you think the biggest problem is. Now, as you might know, both of these are big problems right now. This has been the big problem of Jerome Powell's conferences all this year, where he says we have this dual mandate and it's in tension because we have two different directions we're being pulled. However, you've probably also noticed big layoffs at Amazon, big layoffs at Target, big layoffs at UPS, big layoffs at Starbucks, big layoffs at Intel, big layoffs everywhere. Okay? It's been a horrendous job market this year. A lot of you are searching for jobs and finding it nearly impossible. Okay? It was a no hire, no fire economy, and now it's like a no hire, quite a bit of fire economy. And so the general consensus seems to be that the job stuff is riskier and more danger, while inflation has been held to 3%, which is still above the goal of 2%, but it's not horrendous. So the job market is more scary. However, going into this meeting, a unique wrinkle has appeared. The FOMC, Federal Reserve, is flying blind because we have no jobs report. We have no jobs report. We have no inflation report because the BLS has been skipping them ever since the shutdown. So we're flying blind on government data that is usually really important to help the Federal Reserve make its decision. I also want to say, listen, I've thrown a lot of recession charts at you for over a year now. I've been pointing out, some real signs of weakness in the economy that are trending downwards. There are two new ones that I want to bring up that lead credence to the idea that the job market is even more important to focus on. Number one is that motor vehicle sales have, trucks sales have plummeted. This only happens, it's not like trucks like a F-150. This only happens previously during recession. The shaded bars are recessions. You only see crashes like this in motor vehicle sales during recessions. We're seeing one right now. Additionally, you're seeing a huge decline in temp workers being hired. Again, all previous times you see these big declines in temp work, those are recessions. Even the very small 91 recession, which you barely noticed. There are a lot of signals that there's problems. Additionally, even though a lot of people said, hey, these tariffs are going to be bad for manufacturing in America, okay? They're not going to bring jobs back. They're going to create this inconsistency that makes people just avoid the US or build things elsewhere. But then JD Vance said it's almost like the economic profession doesn't even understand tariffs. And he gloated because it wasn't an immediate effect. But now we flash forward, US manufacturing has contracted for 9 straight months. Maybe the tariffs are as bad as everyone said, okay? Maybe they're actually not working. All of this adds up to a very predicted rate cut today. The markets and the betting markets all had a 25 basis point rate cut today. And guess what? As of 15 minutes ago, it happened. We got the cut. Okay. However, there was a rare 3 dissents. Now, this is a vote. FOMC is a vote. There's a chairman, Jerome Powell, kind of leads the discussion, but it is a vote of the Federal Reserve Board. And there were 3 major dissents, which is higher than usual, who all said we need to either keep rates flat or even raise them because inflation is becoming a real problem. So we're getting to a real battle here where within the Federal Reserve, there is big key differences in how they think it should approach what the economy is like going forward, what the biggest issue is. Trump has a very specific idea. He wants cuts. Donald Trump has wanted cuts loudly and insistently for his whole term. He would like a new Federal Reserve chair that will cut rates to stimulate the economy. He doesn't give a fuck about inflation. He said you can always raise them later if you get inflation. We need to boost the economy now. which is good for his polling, obviously. And that's what he likely is going to get in early 26 with Kevin Hassett. This guy is almost certainly going to replace Jerome Powell. And if you don't know this guy, this is the kind of guy he is.
The bottom line is that the Democrats are out there saying things that are false. And so the economy is booming, jobs are growing, right? And so people's incomes are going up by way more than inflation. And that's why we're seeing these blowout sales.
He's a massive Trump glazer who says the economy is amazing. He says inflation is way down. When the jobs numbers are bad, he says it's politically biased.
Now, job openings and layoffs. I know you've seen the numbers.
Right,
the BLS numbers, the layoffs reached 1.9 million.
And so it could be that what's going on right now is that there's a problem with the way the surveys work.
So he's the guy that's going to come in and apparently cut rates in early 26. However, be careful what you wish for. We got the cut today. Any additional cuts after today into 26 are pretty much rock solid signals that the economy has slipped into danger. This many cuts in a row is a sign of like pure panic. So whether they do it because he's forced to or they do it because they have to, we are entering into kind of the end game hearing into 26. Now it's time to listen to him speak. Let's see what Jerome Powell has to say about the economy with the data that he has.
Consumer spending appears to have remained solid, and business fixed investment has continued to expand.
Okay.
In contrast, activity in the housing sector remains weak. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year.
They always predict just
and
stopping and going
thereafter.
down. It's going to keep going up. Like if you go back and look at the previous projections, they always project inflation going down and unemployment rate going down. They always go, no matter what it is, it goes down. But then the real world, it always goes, the projection's not right.
As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may
$40 billion a month.
Months to alleviate expected near-term pressures in money markets. In this regime, standing repurchase agreement or repo operations are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee...
Listen, this is all about the Federal Reserve's ability to print money, to buy government bonds, to control interest rate on the longer term. I'm trying to make it less complicated. But essentially, quantitative easing is a couple keystrokes, new money going in so they can buy government bonds at the Federal Reserve. We've been doing quantitative tightening, which is where they've been letting that shit run off. All the stuff they bought before, they've been letting it expire and not repurchasing. Now we're back to QE, which is again another sign of stress in the economy, a sign of them trying to put liquidity and new money back into the economy. Okay, a little offline update because it's hard to cover this stuff live while Jerome Powell's yapping, and I want to make sure you understand through all the jargon. Okay, I wasn't the only one who, while live watching this, noticed how similar what was being announced was to the old idea of QE or quantitative easing, where they print money to flood stimulus into the market, essentially. Michael Burry had a long post pointing it out. FT's Alphaville did a great article right at the end. They're like, hey, we're in a new era of QE crossed out. Sorry, RMP. That will start in January. And of course, Wall Street Bets picked up on it instantly with the classic money printer meme. We are so fucking back. So I want to cut through the jargon a bit and try to understand like specifically what they were saying now that I've had a chance to review the transcript. The repo market in America is basically between banks, and basically it acts like a pawn shop. So let's say you're a bank. I deposited a bunch of money at a bank. The bank doesn't hold on to cash. So they take that money and they buy government treasuries, or they loan it for houses or whatever. They put it into something. But sometimes the banks need cash. The overnight repo market is where a bank can say, hey, look, we've got a bunch of government treasuries that are worth a lot of money. We don't want to sell them. Can we stash them with you to get some cash real quick, and then we'll buy them back ASAP. And then trillions of dollars goes to this every day because a lot of banks need cash for whatever reason or another. They borrow money from another bank, they get this, they turn it back, that bank borrows from another bank. Everyone's just borrowing in a circle for when they need cash, okay? Because everybody wants to hold a bunch of money in cash. The problem is when banks are stressed, when banks feel like they want to hold on to all the cash they have because maybe they've made some bad loans or things are getting more stressful in the economy, they stop loaning to each other and the repo market starts to break. They go from friendly pawn shop owners to this guy and they start charging a lot more to hold on to your crap and give you cash. And that gums up the whole financial system. This kind of was happening in 2019, but then we had COVID happen and a ton of free money hit the economy and everyone forgot about it. When banks become stressed with each other, the whole thing freezes up. So the Fed established a facility in 2021 to kind of make sure this didn't happen in the future. It's the standing repo facility of the government, which is like a government pawn shop. You can always bring your crap government bonds to them and they'll give you cash. And the problem is you have to do it publicly. And it turns out that any bank that uses this is signaling to the whole market that they're broke and stressed. So everybody's afraid to use it because if they use it, then usually their stock drops because people know they're in trouble. Like it's a sign of real stress to be using this facility. So the only real solution to keep everything running good with the banks is for Jerome Powell to come back with a money printer, get liquidity back in the market, and make it so banks can lend to each other. So they called this RMP, Reserve Management Purchases. I mentioned in a previous clip, they're going to invent new acronyms, bro. And they are. They're inventing new stupid acronyms that all mean the same thing, which is get the money printer going. Reserve Management Purchases. The government is going to start buying a whole bunch of short-term bonds so that there's money back in the economy and everybody loans to each other again. Now, the takeaway from this, and I didn't really catch this live, but the real takeaway from this is that the Federal Reserve sees real stress in the banking sector. Like banks have probably made a lot of bad loans over the past few years. And they're getting more risk averse and they're choking back their access to credit and they're holding on to money. And this is designed to prevent that, but there's probably going to be more needed. I mean, they're talking about buying 40 billion of these a month to get the cash back into the economy, but other banks are even saying it might have to do 100 billion at once, right at the start, just to get things going again. We'll see, but again, like I said, no one can ever predict a government's ability to make up new acronyms and get things going. But the general idea is this line's going back up. We had a very brief period where they tried to normalize it. We didn't even get close to pre-COVID levels. Now we're already back to stimulus again. Okay, back to the live.
Eliminated the aggregate limit on standing
We have been back to QE for a while.
These operations are intended
and then
to
I
support
also
monetary
mentioned
policy implementation and
listen, they're going to find so many different fucking ways to use repo facilities, reverse repo facilities to get money into the economy to try and prop things back up. He's going to list a bunch of different fucking words that all boil down to that.
smooth market functioning and should be used when economically sensible.
Just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last.
Like he's basically saying, if we cut again in 26, it's a sign of stress. He's saying we've cut it 3 times. We're probably in the range of what is an appropriate neutral rate. If we're cutting again, danger.
You have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI.
Think about that. Think about that prediction. In the next year, we're going to get some fantastic increase in productivity from AI that doesn't create new jobs, but creates a ton of new growth. It's not happening. We haven't seen it happen yet.
Also, I think productivity has just been
the next
almost
version
structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Today's decision was clearly very divided. It wasn't just the 2 official dissents against the cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, The situation is that our two goals are a bit in tension, right?
Yeah.
So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look?
I just want to say that is a pretty crazy statement on its own. That is that everyone at the FOMC agrees that inflation is bad and jobs are bad. And they're just debating over which one's worse. That is not like, we've watched conferences where they're like things are good, or they say they think it's good. But now they all agree that both of their dual mandates are bad.
We're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the
is this a fancy way of saying he doesn't trust it, bro? He's saying we're gonna eventually get a jobs report and an inflation report, but we have to be careful about it. I mean, I wouldn't trust it either if it comes out after it's been canceled for a month and they go, everything's great. Inflation has plummeted. Trump golden age.
In the 1990s, the committee did two discrete sequences of
90s
three
kid.
quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
What a stupid fucking question. You've been listening the whole time, Nick Timmeros? He's going to say very obviously, it's not a foregone conclusion. We're very data dependent. Our dual mandates in tension. We have the ability to both raise or, of course.
What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy?
You shouldn't have any confidence that it won't keep rising in 26 because it will keep rising in 26. I'll say it with full confidence, Nick Timmeros. The unemployment rate will continue to rise in 26. Okay? It doesn't just flatten out and go down. It's going to keep rising. I don't care what Jerome Powell says.
Claire Jones, Financial Times.
FT!
A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead?
A little bit of fear?
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000.
I'm glad you can just say it. Yeah, it is overstated, bro. The jobs are declining. Yeah, I'm shocked you said that. Yeah, that's why you have to cut, because there's not 40,000 new jobs a month. There's negative 20K or more.
And so I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought.
They always have to couch it in language like, it's all good. Like it's never like, damn, that's a lot of layoffs. It's always like the labor market is cooling so gradually. It's like a delicious pie on a windowsill. It's like just it's like for regular people, it's like, damn, I can't get a job. Everyone's firing. It's a breezy, cooling.
There's also a secular ongoing growth of the balance sheet. We have to keep reserves call it constant as it relates to the banking system or to the whole economy. And that alone.
I need to go over this transcript with a fine-tooth comb and really wrap my head around what he's saying here, because it smells a little bit like bullshit. Like, quite certainly, we didn't need this level of reserves in many previous eras of the American economy. I don't understand why he's saying it's like, he's making it seem like this is a very normal thing. He's trying to put a lot of language to, but it doesn't sound normal.
For us to increase about
but
$25 billion per month.
Make sure I'm not missing something that he's saying.
So that's a small part that's going on. If there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. You know, we haven't been able to predict this with any precision. No one is.
So you don't know anything.
Call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. But and after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
He does have some Giga Chad moments. I like Jay Powell. It's a tough job. I don't know what he's got to not panic people. He's got to balance the fucking dual mandate. He's got to. I give him credit where credit's due, but he is kind of like reaching the end of what you can jawbone, which is what they call it when they try to use their words to influence market perception. Like he's just like trying to project this air of they got it under control.
10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most? So
this is a fucking great question. I want to explain it a bit. So the Federal Reserve only changes the interest rates, which is the cost to borrow, on the short term. But the 10-year yield, the 10-year borrowing yield for U.S. IOUs is kind of what sets the prevailing interest rates for things like your mortgage or a long-term auto loan or a credit card loan. Like that's where the interest rates that you feel in the economy have to be around, okay? And the 10-year yield is not controlled by Jerome Powell or the Federal Reserve. That's just the market. That is people's confidence in the US dollar. That is people's confidence in putting their money in US treasuries. So if this goes up, which it has since they started cutting, I don't know, like September. It's like, I think this point in September they started cutting. In his question, they mentioned that it's up. So this is what you want to get down. This is what Trump would like to get down. That's what everyone would like to get down, because it brings down the interest rate on your mortgage and everything like that. But this is that they can't control this. They can't just change that number. And his question was, okay, you keep cutting the short-term rate, and usually this follows, but it hasn't been. So why do you think cutting it again will make this follow?
So we're looking at the real economy and focusing on that. And you've got to, when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very, that's one part of it is inflation compensation break-evens. And, they're at very comfortable levels. They're at levels consistent. Once you get out past the very short term now, break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So
I don't know what fucking surveys he's reading. Like, here's a fucking bank rate survey. Most people say their pay is not keeping up with inflation. And basically they're saying that prices are rising faster than wages. I don't know where he's pulling these surveys that most people say they project a sustainable 2%.
Keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think it's I don't think this is particularly controversial. It's very difficult to estimate
the birth death model.
They don't count everybody. They have a survey, and there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right, and that was exactly what happened. So, but the thing is, that's job creation in a way. That's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully.
Yeah, that's bad, obviously.
Where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in
AI washing
into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance. And
Uber. Jerome, it's Uber. It's fucking gig work. People aren't firing for unemployment insurance because they're taking gig jobs, okay? Unemployment is this huge fucking hassle for small benefits. It's not worth the fucking squeeze. So they work for DoorDash or Instacart or Uber or fucking as filler. And so it's not reflecting in the continuing claims numbers, but it is a rising sense of people opting out of searching for a real job.
Since job creation, job finding rates are extremely low. If there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up.
There are big layoffs, but this time around we have gig work, and that's why you're not seeing it in the normal past. You'd see it.
Really haven't much, so it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Well, I would argue that it is showing up in layoffs, but I don't think these layoffs are because of AI. I do think some of the reason companies aren't hiring new college graduates is because of AI, because they're trying to figure out whether they can replace that person's entry-level job with AI and a senior employee doing basically more work using AI. I think there's a bit of less hiring because of it. But the layoffs are not because of AI. The layoffs are just, they say AI so it's better for their stock price. If you lay off a bunch of people, oh, that looks kind of bad. If you lay them off for AI, oh, this company's forward thinking. And it's just, that's what it is.
I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy? And what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts.
Bro, okay, so I've been talking about K-shaped economy for a fucking year and a half. It doesn't come from me, even though people on Reddit are like, oh, K-shaped economy? That comes from Peter Atwater, who got it from a random poster on Twitter. Well, Peter Atwater's a guy I like to read. Doesn't have a fucking massive audience, but a good Substack. Peter Atwater is the one who first said K-shaped economy, and I've been fucking hammering that shit home for a year and a half, because I think is the perfect description for what you're actually seeing in the real world. You see a big headline spending number, but you break it down and it's like the rich people who have house price up, stock price up, they're spending like crazy. They feel good. They feel great. Bro, I'll just be real. My shit's doing pretty good the past few years, but I'm not stupid. I just went back home, Arizona, spent time with my friends and family. Dude, a lot of them, same school as me, same age as me, Some of them are working as fucking teachers, different job. They're kind of low-key soft struggling because it's fucking hard. It's hard. Some of them are starting families. It's expensive. It's just more difficult than it was in 2014, 15, 16, 17. Of course, it's just way more difficult, obviously. It's just so wild that it's just not like more readily apparent. Like everyone's saying K-shape now, and I hope he answers it. But it's like, it's such a dispersion. And when you average it all together, you can be like, well, yeah, look, the number's up. But it's not, it's not really up. It's not, most people aren't feeling that at all.
And just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So
it should be so clear. What he's saying is 100% true, and I don't think he was deliberately misleading. But it's not they tend to be owned. It's not like, well, I guess some of the assets are owned by the wealthy people. It's like 99% of all the assets, all the housing and all the stocks are owned by the top, not even 10%, but really like the top 2%. But if you do the top 10% of the economy, they have everything. They have all the stocks, all the housing. It's not 10. It's like, it just is. They are the ones feeling good because that stuff is up. And everyone else who doesn't have access to that is not really feeling good at all.
I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave, sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so all of us who work in economics jobs are really fortunate to have the U.S. economy. So thank you very much.
Oh, that was it? All right, man. Jerome Powell, no home Jerome. We had 3 FOMCs left and then he's gone. But not forgotten. You're in my heart always, Jerome. He sounded more negative in the last, maybe the one before that. This one, he sounded a little bit more iffy, a little bit more upbeat. But I do think it sounds like he's trying to put a nice bow on everything before he hands it off. I was kind of wondering why he was like, the data's not improved. In fact, they don't even have data. And he's like, oh, well, things are good. I think he's trying to wrap it all up and say, listen, things are pretty good. We're in a good spot. We're in neutral. Now it's your turn, young fella. And hand it over to Kevin Hassett.